Investing in large-cap growth stocks has been a consistently lucrative strategy over the long term. These companies, often pioneers in technology, healthcare, and consumer goods, exhibit the potential for sustained, above-average growth. With the rise of exchange-traded funds (ETFs), capturing this market segment has become more accessible than ever. Two highly prominent options for exposure to large-cap growth are the Invesco QQQ Trust (QQQ) and the Vanguard Growth ETF (VUG). While both track broadly similar segments of the market, choosing between QQQ and VUG involves understanding their nuanced differences. This article delves into the key characteristics of each ETF, comparing their underlying indices, performance history, cost factors, and sector weightings. By dissecting these aspects, investors can make a well-informed decision about which ETF aligns best with their individual goals and risk tolerance. Understanding the underlying indices. The foundation of any ETF lies in its underlying index. QQQ tracks the nasdaq 100 index, comprised of the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. The index is market cap weighted, meaning the heaviest holdings are based on a company's total market capitalization. Conversely, VUG tracks the CRSP US Large Cap Growth Index, focusing on approximately 250 leading U.S. growth companies regardless of exchange listing. The index employs a modified capitalization methodology, placing greater weight on stocks exhibiting higher expected growth rates. Performance history, weighing past returns. Evaluating past performance, although not predictive of future results, can provide valuable insights. Over the past 5 years, VUG has marginally outperformed QQQ, generating an annualized return of 23.4% compared to 22.2%. However, it's crucial to contextualize this trend. VUG's outperformance largely coincides with strong periods for specific growth sectors like healthcare and consumer staples, which receive greater weight in its index. During technology-driven rallies, QQQ tends to fare better due to its heavier concentration in tech giants. Cost considerations, expense ratios matter. Expense ratios, representing the annual fees charged by the ETF issuer, directly impact investment returns. VUG boasts a significantly lower expense ratio of 0.04% compared to QQQ's 0.2%. This translates to a substantial cost difference over the long term. A $10,000 investment in VUG incurs an annual fee of $4, while the same investment in QQQ translates to a $20 charge. While seemingly small, these fees can compound significantly over extended investment horizons. Sector weightings, examining under-the-hood composition. Both QQQ and VUG primarily invest in technology and healthcare stocks, reflecting the predominance of these sectors in the current large-cap growth landscape. However, subtle differences exist. QQQ holds a higher concentration in information technology, with Apple, Microsoft, and Amazon occupying its top 3 holdings. VUG, on the other hand, allocates more weight to healthcare and consumer staples, with companies like Johnson & Johnson, Procter & Gamble, and Visa featuring prominently. The choice is yours, a tailored approach. Ultimately, the decision between QQQ and VUG hinges on individual investor preferences and risk tolerance. For those seeking pure nasdaq 100 exposure and comfortable with higher technology concentration, QQQ might be the preferred choice. Conversely, investors seeking diversification across exchanges, prioritizing exposure to healthcare and consumer staples, and valuing lower expense ratios may find VUG to be a more suitable option. Beyond QQQ and VUG, alternative considerations. It's worth noting that QQQ and VUG are not the only avenues for accessing large-cap growth exposure. Several other ETFs offer variations on this theme, catering to specific interests or risk appetites. For instance, the Invesco QQQ Trust Series 1, ONEQ, provides equal-weighted exposure to the nasdaq 100, potentially mitigating concentration risk. Additionally, ETFs like the SPDR Portfolio Large Cap Growth ETF, XLG, offer broader diversification by including financial companies. In conclusion, choosing the right tool for the job. Both QQQ and VUG offer compelling options for capturing the growth potential of large-cap American companies. By understanding their underlying indices, performance history, cost factors, and sector weightings, investors can make a well-informed decision that aligns with their specific investment goals and risk tolerance. Remember, diversification is key in portfolio construction, and exploring alternative ETFs within the large-cap growth landscape can further enhance your investment strategy.